All right, let's dive into the Infosys Q3 earnings call. Now, on paper, this thing looked like a miss, but the market, it went on an absolute tear. So what in the world did investors see that the headlines completely missed? Let's break it all down.
So get this, on January 14th, the day they announced, Infosys's shares, the ADRs, just rocketed higher by over 10%. You know, in a market that punishes even the smallest mistake, a surge this big, well, that's not just noise. That's a huge statement from investors.
And that brings us to the big puzzle of the quarter, right? The company missed its earnings numbers, so why the explosive rally? Clearly, the market was looking way, way beyond that single headline number. Let's unpack what it was seeing. Okay, first up, let's talk about that market reaction. Because in this story, the price jump was really only half the picture. The real tell was the conviction behind all that buying. Just look at the volume here. On earnings day, we saw nearly 38 million shares change hands. That's almost 3 times the daily average. A price surge backed by this kind of volume, that's no fluke. It tells you that the big money, the institutions, were stepping in and deploying some serious capital. They were fundamentally re-rating the stock. So, if the market was so incredibly bullish, what were they seeing? Well, it turns out the smart money completely ignored the headline miss and honed in on a totally different and frankly much more telling set of numbers. And here's the first clue. On the left, you've got the miss, right? GAAP earnings per share came in at 19 cents, just a penny shy of what everyone was expecting. But look to the right. You see the beat. Revenue of $5.1 billion actually edged out expectations. And a top-line beat like that, it's often a much, much stronger sign of a healthy business than some minor bottom-line miss. And look, management had a really clear explanation for that EPS miss. They said it was a one-time charge, something to do with a change in Indian labor codes. So if you adjust for that one thing, guess what? EPS was right in line with expectations at 20 cents. And even more importantly, the adjusted operating margin was a super healthy 21.2%. The market was smart enough to see right through the accounting noise to the strong underlying profit. And this is what absolutely sealed the deal for investors. While the last quarter was a little noisy, the outlook is crystal clear. Management actually raised its full-year revenue growth guidance and backed up its strong margin outlook. I mean, that's the ultimate signal of confidence. And the kicker? This guidance doesn't even include potential revenue from a pending joint venture with Telstra. That is all pure, unadulterated upside. Now, that guidance wasn't just some wishful thinking. No, it was backed by an absolutely stellar quarter of winning new business. And that brings us to the company's deal engine, which was just on fire. The company booked a massive $4.8 billion in total contract value, or TCV, for its large deals. Now, this number basically represents the total value of all the new contracts they signed. And in the world of IT services, let me tell you, $4.8 billion is a monster number for a single quarter. It shows clients are committing to some major multi-year projects. But when you dig into the quality of that growth, the story gets even better. A whopping 57% of that deal value was net new. This is such a critical metric. It means Infosys isn't just renewing old contracts to keep the lights on, it is actively going out there and taking market share from its competitors. This is aggressive, offensive growth. Okay, so what's the big story tying all of these strong numbers together? Well, management hammered this point home on the call. Their strategic pivot to becoming a leader in enterprise artificial intelligence. The CEO, Celil Parek, he didn't just talk about AI in these vague, fuzzy terms. No, he laid out a very specific vision. He framed AI as a set of distinct, monetizable opportunities that he believes Infosys is perfectly positioned to capture. And this is that strategic roadmap in action. This is their playbook. From doing foundational data work to modernizing old systems and rolling out AI agents, Infosys laid out exactly how it plans to translate all that AI hype into actual revenue. For an investor, seeing a clear, structured path to growth like this, that is absolute gold. And this is critical. They backed up the strategy with hard data. This isn't just some plan for the future. It's happening right now. We're talking thousands of active projects, hundreds of agents already deployed, and key partnerships like the one they have with Cognition AI for their Devon agent. Infosys showed real, tangible traction, and the market loves to see proof points like that. So let's put it all together. You've got a noisy headline miss, but that was totally offset by a revenue beat, raised guidance, massive deal wins, and a really compelling AI story that has real traction. So what's our call on the stock from here? Our rating is outperform. The market reaction was, in our view, completely justified. Investors are correctly looking past that short-term accounting noise, and they're buying into a really powerful, forward-looking story of market share gains and AI-led growth. We believe this re-rating has further to run. So how would we play this? Well, we see a two-part idea. The core position is pretty straightforward. Go long the INFY ADRs. That strong guidance gives you a nice valuation floor, while the whole AI story provides the catalyst for multiple expansion. Now for the kicker. More advanced investors could think about selling out of the money puts. In simple terms, this is a way to get paid for being bullish. It's based on the view that the stock is unlikely to fall significantly from here, and it's a strategy that can effectively lower your entry price. And as always, please remember this is not financial advice.